Hi everyone, this is the Encyclopedia channel. In this program, we will learn about inflation with you. How do we understand inflation? What are the consequences of inflation? How should we ordinary people deal with inflation? Inflation refers to the decline in the purchasing power of money, that is, the overall increase in prices. Inflation occurs when prices rise faster than the money supply grows over a period of time. Inflation is a complex phenomenon that is often closely related to the macroeconomic environment and monetary policy. In modern economic systems, the growth of the money supply is usually determined by central banks or government policymakers. The adjustment of monetary policy can control the level of inflation by influencing interest rates, controlling money supply, and other means. The impact of inflation is comprehensive, affecting prices, interest rates, wages, and economic growth. A high rate of inflation may lead to price uncertainty, increase costs for businesses and individuals, and reduce economic growth. In addition, inflation can also lead to a decrease in purchasing power, further exacerbating the problem of inflation. To combat inflation, policymakers take a range of measures. These include adjusting monetary policy, controlling fiscal expenditures, and reducing money supply. Inflation trends can also be predicted by monitoring economic data so that responses can be better formulated. Inflation is an unavoidable part of the economic system, but policymakers take appropriate measures to control its impact and ensure the stability and healthy growth of the economy. So, what inflationary events have occurred in the global economic and financial history? Let's first look at the most notable cases of inflation below. Inflation in the German Weimar Republic, 1914 to 1923. After World War I, Germany's economic situation deteriorated sharply. In order to pay large amounts of war reparations and war debts, the German government began to increase the money supply, causing prices to rise. By 1923, Germany had experienced the worst inflation in history, when a banknote was worth less than the paper itself, and the currency depreciated by a staggering 3 trillion times. Inflation during periods of high economic growth in Japan, 1955 to 1970. In the early 1950s, Japan experienced a wave of post-war reconstruction, and its economy grew rapidly. However, the economy overheated in the early 1960s due to massive fiscal and monetary policy stimulus by the government, leading to high inflation. The Japanese government adopted a number of policies, including restricting the money supply and price controls, which finally succeeded in controlling inflation in the early 1970s. Inflation in the United States in the 1970s. In the early 1970s, the United States experienced a period of severe inflation. One of the main reasons is that the U.S. government adopted an expansionary fiscal policy and loose monetary policy, resulting in a rapid rise in the price level. The highest point was in 1979, when the inflation rate reached 13.3%. In response to this situation, the U.S. government adopted contractionary monetary and fiscal policies, which finally succeeded in controlling inflation in the early 1980s. Latin American inflation crisis, 1970 to 1990. In the 1970s and 1980s, many Latin American countries experienced severe inflation. The main reason is that the government has adopted over-expansionary fiscal and monetary policies, resulting in an inflation rate of more than 1,000%. Inflation has led to problems such as currency devaluation, widening gap between rich and poor, and social instability. In order to solve this problem, many Latin American countries have implemented structural reforms, including reducing government intervention in the economy, implementing market-oriented reforms, reducing government expenditures, and other measures, and finally, successfully controlled inflation. Eurozone debt crisis, 2008 to 2013. When the global financial crisis broke out in 2008, the euro area was also severely impacted. Due to the excessive government debt of countries such as Greece, there is a debt crisis in the Eurozone. In order to avoid a debt default, the European Central Bank has adopted a large-scale monetary stimulus measures, leading to inflationary pressures in the Eurozone. However, because the European Central Bank's policy is not timely and effective enough, the inflation rate is lower than the target level, and there is even a risk of deflation, exacerbating the complexity of the debt crisis in the Eurozone. Venezuelan inflation, 2014 present. Venezuela is one of the most inflationary countries in the world. Due to the Venezuelan government's economic policy mistakes and the drop in oil prices, Venezuela has experienced persistent inflation and economic collapse. Inflation in the country hit 1,000,000% in 2019, according to the International Monetary Fund. Inflation led to severe social unrest and poverty, and thousands of people fled the country. Inflation is a common problem in the process of economic development. Although inflation may promote economic growth in some cases, excessive inflation will lead to wealth redistribution, reduce investment and consumption, and damage economic stability and social welfare. Faced with such a serious problem, it is necessary for us to understand how inflation arises. First, too much money supply leads to inflation. When a central bank increases the money supply, people have more money, which causes demand to rise. But if there is no corresponding increase in production capacity, supply cannot meet demand, and prices will rise. Excess money supply is usually caused by central bank monetary policy. Second, excess demand is also one of the causes of inflation. Excess demand occurs when people's demand for goods and services exceeds supply. This can lead to price increases, as the shortage of supply causes merchants to raise prices. Excess demand usually occurs during good economic times, when people have more income and confidence, and they are more willing to buy goods and services. In addition, cost-push inflation is also due to rising production costs, leading to higher commodity prices. For example, rising energy prices will drive up costs for producers, causing them to raise prices to maintain profits. This cost-push inflation usually occurs through rising raw material prices, rising labor costs, etc. Finally, an increase in the tax burden can also lead to inflation. An increase in the tax burden will increase the price of goods. Taxes are the main source of income for the government, but increasing taxes makes goods more expensive because businesses have to pay more in taxes. Increased tax burdens can also lead to inflation. In short, inflation is caused by a combination of factors. The central bank needs to pay attention to monetary policy and control the money supply to avoid inflation. The government should also adopt effective fiscal policies to promote economic stability and sustainable development. Otherwise, it will lead to more serious consequences. Inflation can lead to currency devaluation. If inflation persists for a long time, the purchasing power of the currency will decrease. Because prices rise, people need more money to buy the same amount of goods and services. This also affects import and export trade because of the relatively high purchasing power of foreign currencies. Inflation leads to social instability. When inflation is high, people feel uneasy because their money loses value. This will lead to a decline in society's trust in the government and economic system, and it may also lead to social unrest and political instability. Inflation can also have adverse effects on businesses and individuals. Production costs for businesses would rise, which would lead to lower profits, potentially reducing investment and job creation. For individuals, inflation reduces their purchasing power, making it harder for people to choose between spending and saving. After retirement, inflation also reduces the purchasing power of people's pensions and savings. Finally, inflation can also have a negative impact on the economic system. Inflation can cause disequilibrium and confusion in the economy, making markets unpredictable, exacerbating economic volatility and periodic depressions. In addition, high inflation can also render fiscal and monetary policy ineffective, making policymaking more difficult for policymakers. Inflation can negatively affect the economic system and society in many ways. The government and the central bank should adopt effective policies and measures to control the inflation rate and maintain economic stability and social prosperity. In the 1980s, Paul Volcker, a famous central banker and economist in the history of the United States, was appointed as the chairman of the Federal Reserve Board of the United States. He adopted a series of tightening monetary policies and successfully fought against the high inflation in the United States at that time. Swell. During Volcker's tenure, the United States faced extremely high inflation rates, especially in the late 1970s, when the inflation rate in the United States was as high as about 14%. In order to deal with inflation, Volcker implemented a series of tightening monetary policies, including raising interest rates, tightening credit, and other measures. He also instituted a new monetary policy framework, the Inflation Control Guidelines, which aims to reduce inflation by controlling the money supply. Although these policy measures caused much controversy and opposition in the early stages of their implementation, in the end they proved to be successful. Under Volcker's leadership, inflation gradually fell and the U.S. economy began to recover. Moreover, Volcker's approach to combating inflation had a positive impact globally, with many countries beginning to adopt similar monetary policy measures. In addition, under the background of inflation, people's purchasing power has been affected. As an ordinary person, how should we deal with inflation? First, we can take the approach of controlling spending. Inflation will lead to rising prices, so we need to reasonably arrange personal or family expenditures and avoid unnecessary waste as much as possible. We can compare prices when shopping, choose products with better value for money, and avoid overspending. Second, we can consider changing the way we save. Since inflation reduces the purchasing power of savings, we need to find ways to save against inflation. For example, you can choose to buy fixed-income financial products, or consider investing in stocks and other assets to resist inflation risks. In addition, buying real assets such as real estate, gold, etc. is also a way to fight inflation. Third, we can consider increasing income. Since inflation will lead to currency depreciation, we need to consider increasing our income level to deal with the negative impact of inflation. We can increase our income through overtime, side jobs, self-employment, etc. Fourth, we can avoid the risk of inflation by learning and investing in financial knowledge. Learning some financial knowledge and understanding monetary policy, economic conditions, and other information can help us better predict and deal with inflation risks. At the same time, we can also consider investment and financial management and avoid inflation risks by choosing appropriate investment products. In short, for ordinary people, there are many ways to deal with inflation. Only through rational financial management and reasonable consumption habits can we better resist the impact of inflation and ensure personal financial stability and development. This program ends here. How do you understand inflation? Welcome to leave a message in the comment area and discuss with everyone.